Hey everybody, welcome back to Dividend Stockpile. We're here with one of our favorite guests, Troy Cates from NEOS Investments. I'm here to talk to us about their 2024 results, how 2025 is going for them, and some other items that might be of note. So stay tuned. And Troy, welcome.
Thanks for having me.
So nice to have you back. Really appreciate all your time and coming on the channel to talk about all your products and informing the audience out there what NEOS can offer everyone. So for those who may not be familiar, can you just do a quick, brief introduction to yourself and to NEOS?
Sure. So my name is Troy Cates. I am a co-founder and managing partner here at NEOS Investments. We are based in Connecticut, and we are an asset manager that brings out ETFs. So we're an ETF issuer that focuses primarily on option-based ETFs and tax-efficient monthly income. We have a total of 10 ETFs out in the marketplace right now, and we're continuing to grow. So keep an eye out for what we have coming soon.
Yeah, it's been great seeing all the new innovations you guys have come out over the last few years and different income-focused ETFs. For income investors like myself, your products have really hit the sweet spot between the capital appreciation as well as the current income. So, and I obviously love the monthly distribution. So it's been a great suite of products, if you will, that you guys have been offering and just continue to come out with, really great diversified options. I mean, you have everything from S&P 500, QQQ type of products, to Bitcoin products, to real estate. Like, you guys really do have a lot of options for people to pick from. So really appreciate your line of ETFs. So hopefully everyone else does as well. Looking at your total assets under management, I definitely think a lot of people do appreciate your products because it's been growing pretty well over the last couple of years.
Yeah, so we launched our first 3 ETFs back in August of 22. So we're almost at that 3-year track record for those initial ETFs. But yes, like I said, we've grown to 10 ETFs. We have more in registration. We have over $5 billion in assets right now across those 10 ETFs. And as you were saying, we try to look at ourselves more as a solutions provider. We want to kind of, as you look at your asset allocation, we want to have that growth area. We want to have those alternatives, those fixed income products, those ultra short duration. And we want to be able to fit into most people's portfolios, especially if you're looking for, income in your portfolio in a tax efficient manner.
Absolutely, yeah. The tax efficiency that you guys offer is a great differentiator for you, and it really helps your investors. And I know we're going to talk about that a little bit later on, but it's definitely a great feature that you guys are able to offer on most of your products. All right, well, let's get to it. So the main reason I wanted you to come on is to kind of talk about your 2024 results of your different products. We're going to hit a couple of the most popular ETFs out there right now and how they did in 2024, and then your outlook for 2025. So let's go and start with SPYI. Overall, that's one of your older products. It's one of the most popular products. So can you tell us a little bit about your 2024 results and how it compared to the index you guys follow?
Sure. We were really excited about how 24 turned out for SPYI. So the fund grew a lot, brought in more assets, currently over $3 billion in assets in SPYI. But we had great performance. So if you think about what the S&P 500 did last year, it was up 25% for the year, which is an incredible year considering the year before it was up about 25% for the year. So last year in 24, SPYI was able to return over 19% total return for the fund. And out of that 19%, the fund distributed about 12%. So just about 1% a month. So very strong performance, nice distribution, but continue to appreciate and grow NAV.
Yeah, that's great because a lot of the ETFs out there, especially the higher yielding ones, their NAV is being reduced over time. And so it's nice to have the NAV appreciation as well as the income. And if you're in the stage where you're still growing your assets and you're reinvesting those distributions, you're taking advantage of that high yield that you guys are offering right now. Based on the results, how do you feel it did compared to what your expectations were, and how did it go against the S&P 500 itself?
So it fell right in line with where we thought it should be and what we built the product for. So capturing, anywhere, the goal is to capture anywhere from 2/3 to maybe 3/4 of the upside of the underlying S&P 500, while still providing that income on a monthly basis and trying to do that in a tax efficient manner. One, I know we've talked about this before. We try to use index options wherever we can. So we use those S&P 500 index options for the tax efficiency. And then wherever we can, when the end of the year comes, seeing how that potential income, part of it can be converted into return of capital. And I know we've talked about this before, and it's a touchy subject for some, but we're not looking to return principal. But if any of the income received or sent out could be categorized as a return of capital from an IRS perspective, you're basically lowering your cost basis and deferring your taxes to a later date. So that seems to be very attractive to a lot of income investors because they could defer their taxes down the road and potentially have it more as a long-term cap gain at that point.
Absolutely. And for most of us, we're not ever looking to sell the underlying ETF or holding. So for us, return of capital allows us to receive the income without the taxes. And if we never sell, our cost basis will go down over time. But in the meantime, we're not paying any taxes on the majority of the distribution. So it's a great balance, especially for those income investors who are looking to save a little bit on taxes compared to some of the other ETFs out there. So SPYI had a great year, very stable, broad underlying, as well as the income that you get from the options. But QQQI, I noticed it had honestly a fabulous year. So can you tell us a little bit about 2024 for QQQI?
Yeah, so if you'll recall, we launched QQQI at the end of January. So January 30th was when it came out to market. So we didn't get a full calendar year, but for that part of the year, call it 11 months, we were able to have a really nice total return of over 19%. And during that time frame, the NASDAQ 100 was up about 21%. So a really nice upside capture of the NASDAQ 100, which is traditionally a little bit more volatile and has different returns than the S&P 500. So to be able to capture that much upside of the NASDAQ 100 was a great year for QQQI, and also had really nice distributions throughout the year of just under 14%, just distributing over 1% a month to get you that 14% or so annualized distribution rate.
Yeah, absolutely. What do you attribute to the relative outperformance of QQQI compared to SPYI, compared to their indexes? And it seems QQQI was able to almost match QQQ, but SPYI didn't quite get there. So is there any difference between the two strategies?
The strategies are similar. They're obviously using different underlying indexes. So the SPYI is using the S&P 500 in full replication, buying all 500 plus names of the S&P 500, and then using S&P 500 index options, while the NASDAQ 100 version, QQQI, is using all 100 plus names of the NASDAQ 100 and using NASDAQ 100 index options. So different volatility you'll get from each one. Usually the NASDAQ 100 will have an additional 20% of extra volatility than the S&P 500 might have on any given time. So, those monthly rolls that we do them at the same time for each, but each model is looking at something different because of those levels of volatility and what those index options give.
Okay, that makes sense. And just to round out your high income equity portfolio, can we talk about IWMI real quick and how it did?
Sure. So IWMI turned out great. We launched it in the summer last year, in June, end of June of last year. It had really nice return, but if you think about the Russell 2000, very volatile index, but you will get more income off of those selling of those calls. So we're using those Russell 2000 index options for that tax efficiency. But again, it has more volatility than even the NASDAQ 100. So that distribution rate on an annualized basis is over 14% and higher than triple QI. So we had some nice return performance for the year, specifically compared to the Russell 2000. And yes, we've seen a lot of volatility. We saw a little bit of a sell-off after a huge rally, in the fall. So this is one where we continue to be able to source income from the option market because of that volatility. And so far, we've seen some nice flows, and we're really excited about the future of the growth of that product.
Yeah, no, it's nice to have the option of going to the small caps and getting out of the biggest names, and also, to your point, the volatility of those smaller names inherently allows you to get more options premium. For those who don't do options, volatility is one of the main drivers of the pricing of options. So the more volatility you have, the more up and down you have, the higher your premiums can be, which gives you the higher income over time. So that's great. We definitely had a good year on all your products, but 2025 is turning out to be a little bit different than 2024 so far. There's a lot of volatility, there's a lot of political changes, if you will, different economic strategies than we've had in the past. So the market's taking a little dip. I think the S&P 500, the QQQ, they're down about 10% or so this year. So how has that volatility or that negative sentiment, how did it kind of change your philosophy and your approach to your different products this year going forward?
So if you remember, all of our products and strategies that we build here at NEOS are rules-based and they're systematic.
Mhm.
So we've tested these. We do everything in-house where we're researching. We spend a lot of time, months building these option strategies to overlay whatever index we're looking at, whether it's the S&P 500 or the Russell 2000 or so forth. And we build these strategies to react in all different types of environments. So when we're testing these and building these, we're not looking to say this will be perfect in an up 25% year, but it might not be worthwhile in this and we'll have to change it. We look at it as this is how we built it. There's a number of factors that go into when we're rolling everything on a monthly basis. It's looking at volatility, like we just discussed. It's looking at the rate of change of volatility. And when you factor in all these things as it's starting to figure out how far out of the money do we write these
Mhm.
calls, given where volatility is? How much of the notional do we cover of the underlying index on that monthly basis, given where volatility is? And all of those factors change month to month. And as you said, coming into this year after 2 straight years of big up years for most of the indexes. And then you come into this year, yes, there's a change in the administration.
Mhm.
There is maybe some uncertainty around different things in the market, what the Fed might do, whether it's tariffs or something else being talked about on a daily basis. That uncertainty gets people a little nervous. You start to see the sell-off, but with that, we see a big increase in volatility.
Mhm.
And as volatility ticks higher, as we're rolling these products, it gives our products an opportunity through these rules-based strategies to bring in additional income and maybe write on less of the notional. So when
Mm.
the market does bounce, there's not so much of the notional covered while still hitting those targets that each fund has. So we're not changing anything.
Okay.
We're constantly monitoring everything, of course, but on a monthly basis, when we're rolling, we're looking at all these different factors on a daily basis as we watch flows come in. If we're having a day where the market's selling off and new flows are coming in, volatility spikes, we're able to bring in more income during that
Mm.
time frame. So for us, we welcome the additional volatility. It helps these funds, and it also helps with the nice outperformance on the downside. Remember,
Mhm.
if some of these high income products, whether it's SPYI or QQQI or IWMI, as the market comes in, these products, they don't have a long put or anything like that to hedge them, but you will outperform by the amount of premium you brought in from the short calls.
Mhm.
So you could see some nice outperformance. And then the nice part about it is when the market does eventually move higher, we should be able to capture a good portion of that upside. And that's how the products are built.
I was looking before our call at the returns for 2025 so far, and it's quite interesting because it does mirror, the options premium that you guys received is how much you're outperforming the indexes, or approximately. So it does provide a little bit of downside protection based on the amount of income you guys receive, but it still does ultimately hold the underlying indexes. So you will see some of that downside, but it'll be less down than the overall market because of the options premiums you guys receive.
Yes.
Awesome. Okay. That totally makes sense. I wanted to talk about one of your newer products, IYRI. Is your
Mhm.
new real estate income ETF that you guys launched, what is it, 2 months ago now? So
Yeah.
can you give an update on how that one's going? The tax implications of doing IYRI as opposed to some of the other ETFs you offer?
Sure. So this one is a little different.
Mhm.
There is currently no index options for the real estate sector. We've been talking to people and seeing if we could push that along, but right now there are no index options for real estate. So what we do is we're owning all 60 plus constituents of the Dow Jones US Real Estate Capped Index, which is the same index that IYR follows. So
Mhm.
we own all those underlying, real estates and REITs in there, and then we're using IYR options to bring in the income. Now we use flex options, so we can have them cash settled, so they're not going to be called away from us if the market moves higher or IYR moves higher and we're in the money. So for us, we're sourcing income from the volatility from the underlying real estate portfolio. And with that, we're able to bring in a nice amount of income
Mhm.
and distribute just under 1% a month or so. So we've been very excited about this product. Like you said, we launched it in the middle of January. We've raised over 25 million so far, so really nice initial raise for the first couple of months out the gate. Performance has been really strong. As you can see, it's up, just over 4% or so as of right now, and that, really capturing a lot of that upside of the underlying index, because we're able to write some of these calls further out of the money because of the volatility in the real estate sector. So we're really excited about this one and hope to see it continue to grow.
Yeah, I'm personally a shareholder of that ETF, and it's done really well so far. I really like having the diversity of holding REITs as well as getting the income. But doing calls on the ETF instead of the index does change the tax situation. So can you briefly talk about how that's going to look compared to some of your other funds?
Sure. So you will not get that 1256 contract rule from the index options like we do with SPYI or QQQI or even IWMI. So with this one, and again, just to refresh everybody, that 1256 rule gives you 60% long-term cap gains, 40% short-term cap gains. So index options are inherently more tax efficient than trading an ETF option or a single name option or an equity linked note, where that's all paid out as ordinary income. So for us, to be able to use the IYR options, definitely not as tax efficient, but we will still try to, where we can, have portion of that return categorized as return of capital at the end of the year. So when the tax folks at our tax accounting and auditors go through everything at the end of the year to build those 1099s that go out to all the brokerage houses and eventually to the end shareholders, if any portion of that can be categorized as return of capital, we definitely look for that part. But the actual 60-40 split from the index options, we can't get there yet because there are no real estate index options.
Yeah. Oh, hopefully they come up with one soon. Since we're on the topic, can you briefly talk to everyone about how ROC works and your ETFs and what that might do as a benefit to the shareholders or the unit holders?
Sure. Yeah, no, it's a big topic that comes up a lot. And a lot of people, shy away from return of capital. But if you're thinking about looking at it from a tax standpoint, and if a portion of your distribution that you're receiving, because again, we're paying monthly distributions on all these products, if a portion of it can be categorized as a return of capital, you are lowering your cost basis. And then if you decide to sell the product down the road, you're going to be paying capital gains on that. And most likely you'll hold it for a while and it's long-term cap gains at that point, which is a more tax efficient way for the end shareholder to pay their taxes than paying, say, ordinary income on the taxes on what they're receiving that year. So for us, what we're doing is you're technically harvesting losses within the portfolio. And we're not saying to sell one stock and buy another and harvest it from the equity standpoint. We're looking to leave the equity portfolios pretty much intact outside of some add or deletes that the underlying indexes do throughout the year. And we're looking to harvest the losses within the option portfolio. And in an appreciating market, when the market's moving higher, like it did last year or the year before, you will, inherently have you'll have a P&L every month. But if you have any losses, those losses can build up. And the nice part about the ETF structure is those losses can be carried forward indefinitely. So if you have periods down the road, whether it's next year or so forth, where you're bringing in a lot of gains off the option portfolio, they could be paired off with losses that you had months ago. So what we're trying to do there is those losses pair up, even though we're paying out cash on a monthly basis from that income being received from those option portfolios. If it's categorized from a tax perspective as a loss, then the auditors at the end of the year can say that that was considered a return of capital. And again, I'm not a tax expert, but this is the information that you can go to our website and kind of watch a few videos that we've built to explain return of capital a little better. And of course, always talk to your certified professional who's your tax accountant. But for us, we try to just make these products as tax efficient as possible because they're in an ETF wrapper. ETFs are a very tax efficient wrapper versus other wrappers that are out there. So we wanted to make it even more tax efficient if possible with these monthly income products.
Yeah. Just as an example, can you share what SPYI's return of capital was for 2024, just to give people an idea what you're talking about?
Yeah. So for 2024, the return of capital was just over 93%. So if you think about that, and the other portion was considered ordinary dividends. So when you think about that 93% of return of capital out of that 12% distribution, most of that distribution came to you and yes, lowered your cost basis, but your taxes on that distribution are deferred out to when you decide to pay, or your cost basis goes to zero. And at that point, if you've held the products long enough that you actually exhausted it to zero, you would be paying long-term cap gains on any distributions you received at that point.
Yeah, so it's a huge benefit compared to some of the other ETFs out there. Having their return of capital and delaying the tax obligation is a huge benefit. I mean, when I sell options on my own, I'm paying full my ordinary income tax rate.
Yes.
But if I let you guys do it through an ETF structure with a return of capital, I can delay those taxes. And to your point, eventually there'll be long-term capital gains as opposed to ordinary income. So that's a huge benefit, and that's a huge differentiator from your products. That's one of the reasons why I love it so much. So speaking of the products, so you guys have 10 different ETFs right now. Can you briefly talk about how someone might want to position their portfolio using NEOS products for that stable income every month?
So if you think about our ETFs, like you said, we have 10 different ETFs. We have some treasury ETFs that have ultra short duration or longer duration out to 20 years. We have some fixed income products. We have alternatives, kind of where real estate and our Bitcoin products fall. And then we have our equity products, whether it's the three we've been talking about today, the high income ones, SPYI, QQQI, and IWMI. We also have QQQH, which is our hedged product. And that one, very similar to QQQI, owns all 100 plus names in the NASDAQ 100, selling a call out of the money to bring in income, but it's also buying a long put spread on the portfolio to hedge part of the downside. We're trying to give you a measure of downside protection, not hedge everything to zero, and that rolls on a monthly basis. So that's a really nice product as well. So if you think about it, if you look at your asset allocation, where could you start to think about what kind of income you want, what kind of risk you want to take? Are you younger, want to take more risk, want more equity exposure? Then maybe an SPYI or QQQI fall into that category, or even higher risk, you want to go and have some Bitcoin exposure with BTCI, or you want to take less risk and you're looking at our ultra short duration like a CSHI. So for us to build a stable portfolio for income, when we're talking to advisors all the time, and as they manage a lot of money for different clients, they're looking at what their clients need as far as an income basis, but how much risk they want to take. And then they figure out what makes sense from our ultra short duration all the way up to the Bitcoin income that's putting out, and decide what's a good mix for them. So as you look through our products and start to learn, I think it's important to educate yourself, not only on the tax efficiency side of it that we were talking about today, but look at it from a total return perspective. No matter what a product like a NEOS product or another product is actually paying out on a monthly basis, always go back to total return, because that includes the distribution. And that's important to understand what these products are doing and how they're performing versus their benchmarks.
Okay. Yeah. So personally, just for disclosure, I have SPYI, QQQI, IWMI, IYRI, BTCI, and CSHI, which I just recently added to my portfolio. So, I'm a huge fan, but I just want to publicly disclose that those are my holdings within the NEOS suite, just for awareness of everyone. But I think you guys offer a wide range of different products depending on your risk tolerance and your needs. NEOS does offer something for everyone at this point. And you guys are constantly coming out with new things. I know there's been a couple perspectives put out there that, upcoming products, which hopefully we will talk about in a future episode. But you guys are always coming out with new products. So everyone definitely check out your website, keep track on what you guys are doing, see if something fits for you. Before we end, Troy, I know that 2025, none of us have a crystal ball, but really quickly, does NEOS have an official position on kind of where you see the market going over the next couple of months, or kind of some insights on what investors might be in for this year?
Yeah, we don't make an official, opinion of what the market's going to do, but we did talk a lot about towards the end of the year and going into early this year that we thought volatility would pick up, and it obviously has. And so that's what we're really focused on, where volatility is going, what it's going to look like. It's been very interesting, even with this market sell-off, seeing volatility pick up, but not really pick up to how we've known it to, pick up before. So it's something we keep an eye on, of course, as we're managing these option portfolios.
Yeah.
But I think you think about more volatility throughout the year.
Yeah, that's probably a certainty. I think a lot of people are in that same boat. I mean, just looking at the market this morning so far, when we're recording, the market's way up today. But, last week ended down, and, we've had multiple weeks of down, and S&P 500 is down 10% or something like that for the year. So we're definitely seeing a very different market than we did last year. So hopefully, the economic forecast and all the different things that the Trump administration is trying to put in place, will smooth a little bit of the uncertainty once we get a final decision, whichever way that happens to be. And then, investors can plan accordingly. It's the back and forth is making this volatility really hard to understand and to plan against. So hopefully things will calm down a little bit, but not too much that you can't get a good options premium for us. So I guess it's a mixed bag on what you want, but as long-term investors, take advantage of this market volatility and buy at lower prices. And, if we hold for long term, likely our chances are going to be good that we're going to make a good return over time. Just have to be consistent and have that long-term mindset. All right, Troy, really appreciate coming on. Before we end up, any other insights or topics you want to chat about?
No, thanks for having me. I always enjoy coming on and talking to everybody, and hopefully some people learn a little something and take a look at our products.
Awesome. Yeah, I definitely appreciate you coming back on. You're always welcome back here on Dividend Stockpile. Really appreciate all your insights, and we'll talk to you soon.